So I guess the first point to make is gold is, it doesn't care what the interest rate is. It cares about other things. Interest rates, can seem to be a factor in influencing the gold price in the short run, but in the long run, gold doesn't care. That would be my first point.
Friday, June 21st, 2024, Maneco 64, home of alternative economics and contrarian views. So Clive and I are going to touch upon what's happening in Japan vis-a-vis Norinchukin Bank, difficult one to pronounce. But one thing I wanted to say, Clive, before we start is that what's happening, I think, not just with Norin Chukin, but what happened last year with SVB and the other banks that collapsed and had to be, well, they collapsed, is that we have a committee of men and women in central banks that think they know better than the market where to set rates. And just like central banks cut rates too much, printed too much money back in 2020, 2021, and just like they kept rates near zero or negative since like 08, 09, I think they're doing a mistake now. They don't realize keeping rates as high as they are and how it affects the financial system and the banks. And to me, it just goes to show that the faster we get rid of central banks, the better, because they seem to just create accidents. Is that the way you see it too, Clive?
Well, good luck to them, because they definitely can't see the future, and I'm sure I can't any more than they can. So I'm very glad it's them who's making the wrong decisions rather than I am. But the one thing which does work over all of time is the free market. So if you have a free market without interference, collectively it adjusts so everything comes back into balance. And the minute you have a central bank, they are going to interfere and try to adjust the economy their way of thinking. Now, that might have beneficial effects because it can lead to a smoother passage with less ups and downs. But on the other hand, it's not making the most efficient use of resources.
Yeah, I agree. And I saw a chart of CPI back in the 19th century in the UK. And we still had we had the Bank of England at the time, but they didn't interfere that much. And we had like a sound money system. And CPI used to be up 30% one year and down 30 the next, and up 10, minus 10. There's a lot of chopping and ups and downs, but at the end of the century, CPI was up was unchanged for a whole century, which just goes to show what you said. If you leave it to the free market, there might be some ups and downs, but they adjust accordingly. And I think, unfortunately, what we have today is the Keynesian fallacy that the government has to step in there to make sure that the animal spirits don't die. But maybe we could look into Japan, because their animal spirits seem to have died since 1990, and I would say it's because of all the interference from the Bank of Japan, from the government, and it's showing. So maybe we could talk a little bit about Norinchukin Bank. I think is the fifth biggest in Japan, and we're also going to look at gold later on.
Yeah, so the story which broke a couple of days ago on Norin Chukin Bank was one about them announcing that they're going to sell $63 billion of US treasuries. To put that in perspective, their balance sheet shows they're holding something like, it depends what exchange rate you use, it's in yen, but with the exchange rate of the 31st of December, it looks like they held 80 trillion of foreign bonds. So I imagine most of those foreign bonds are US treasuries. They're going to sell 63 billion of those. So it's almost all of their foreign bonds. So why are they selling? Well, the announcement was they're making losses on them, but it's not the kind of loss you think, well, it is and it isn't. A lot of people are jumping to the conclusion that they've lost money because the price of the bonds has gone down. That certainly is true, because they would have bought these bonds over the last decade when interest rates were much lower. And as interest rates rose, the price of bonds across the board fell. But that's only part of the story. The real crux of the matter is that they're losing money hand over fist on a day-by-day basis. And it's not terribly different from the story with the Federal Reserve, who are also losing money hand over fist, because in the Federal Reserve's case, they're paying lenders to them when they borrow money 5.4%, and they've got a portfolio of bonds yielding about 2.3%. That's not the case with Norin Chukin Bank. They obviously have a portfolio of bonds. We don't know what it yields, but those bonds are in US dollars, and they have hedged the dollar risk, which was unfortunate for them because the dollar's risen, but they've hedged it back into yen. Now, that's the part which is not working for them anymore. And I'm going to explain why. Now, this is perhaps quite difficult for some of your viewers to get around, but I'll try and make it very simple. Interest rates in the United States for the short end, let's call them 5.5%. That's probably the cost of funds if Norin Chukin were to borrow dollars, or if a US bank were to borrow dollars. And in Japan, the short-term interest rate is 0.1%. So when you hedge a currency back to your reference currency, so in their case, they're hedging their dollar bond holdings back to Japanese yen. When you hedge, the cost of hedging is the difference between the two short-term interest rates. So the cost of their hedging is 5.5 minus 0.1, leaves them with a cost of hedging of 5.4% per annum. But they're only earning 4.25 at the moment on their US treasuries. So they are losing more than 1%. So they have a negative return on an interest point of view on their US treasuries due to the cost of hedging at the moment. And now if you compare that with what they can get on a Japanese government bond of 10 years, we're talking about 10-year treasuries here, on a 10-year government bond, Japanese government bond, a JGB, they're earning nearly 1%. But if they have a 10-year US Treasury on an interest basis, they're losing nearly 1%. So it's nearly a 2% difference between the two that they're losing. Plus, of course, because they've hedged the bond, the US dollar bond, back into Japanese yen, they haven't benefited from the rise of the dollar. So they've suffered the full fall in the value of US dollar bonds as well. And I've been checking into their losses over the last few years, and I just got it up on the screen here. I can't show it to you because it's a bit of a mess on a spreadsheet.
Yeah, I'm just showing you how the dollar is rising here against the yen, and this is a very long-term chart. And the 160 level is really important. Yeah, so like you said, they're losing all the benefit of a stronger dollar. Because they hedged, and they're losing 1% because they hedged. So hedging seems to have been a really bad idea. Maybe it wasn't at the beginning, but now it is.
Yeah, exactly. So a few years ago, hedging worked perfectly. Why did it work perfectly? Because they were earning, let's say, 3%, 3.5% on their treasuries and paying only 0.25%. So that would be 0.25% minus the short-term Japanese interest rate of 0.1. Their hedging cost was less than 1%, but they were earning more than 3% on their bonds. So it was working when they started doing this, but unfortunately for them, it's gone wrong. But
that's sorry, just to understand here. So when they were, I guess, borrowing, so they were earning 2 or 3% on their treasuries, but they could borrow like at zero in the US, right? That's why the hedging. But now they're earning only like 4 or 4.5, but they're borrowing at 5.5, right?
Exactly. When the real borrowing cost is the cost of the hedging here in this case.
Yeah.
There's an incidental cost, which is the cost of borrowing Japanese yen. But really, we're looking at the bulk of the cost is the US hedging, and that's costing them nearly 5.5% a year, and they're only earning 4.25% a year on a 10-year treasury, as an example, a bit more on 5 years.
Yeah.
So they're losing money hand over fist. They also lost money because the price of those treasuries has fallen, and they didn't benefit from the rise in the dollar because they'd hedged it again back to yen.
I guess they must have been praying late last year and early this year that the Fed was going to start cutting a lot, but they haven't. And it's kind of it makes you wonder how many other banks, not just in Japan, but throughout the world, are in the same situation.
Well, I thought when this story started to break a couple of days ago, I looked into how much other banks in Japan could be in the same situation. And I only managed to look at 4 banks in Japan. There's obviously a lot more than 4 banks in Japan, but those 4 alone have foreign bonds totaling $500 billion. But they're not the only holders of US dollar bonds in Japan. We've got the Ministry of Finance, who's got 1.138 trillion of US treasuries. And we've got more, the Japanese government pension fund, which has got 315 billion of US treasuries. So if I just add those ones up alone, I'm as near enough at 2 trillion owned by Japanese holders. I'm not really even counting the Japanese housewife here. So I guess the point is Japanese holders who were making money holding government bonds to some extent are no longer making bonds, depending on whether they're hedged or not. But of course, the banks will have hedged. They can't do anything other than that. So the situation for what do you call it? Nut Chucking Bank. That's not the right name. It's called Norinchukin Bank. It must be the same as for many other banks in Japan. I can imagine that, for example, banks like Mitsubishi, UFG, Mitsuho, Japan Post Bank, and all these other banks which are in Japan,
Nomura.
yeah, Sumitomo, they must all have dollar bonds in their portfolio. I can't see why one would have a lot and not the others. I mean, I did say I looked at 4, and collectively it was $500 billion between them, of which Norin Chukin had about 80 something trillion of bonds. So a lot of other firms are probably in the same situation as Norin Chukin, i.e., it's no longer profitable for them to retain the US treasuries. And what Norin Chukin has said is we're going to sell these slowly over the next, I guess, year. I don't think they specified a timescale. Obviously, you can't just chuck 80 billion of treasuries into the market. The market can't absorb that. I did look at the
Right, that's a
daily.
good one. Norin Chukin can't chuck.
Yes, I did look at the daily volume of treasuries trade. I think it was something like 23 billion is traded daily, and they're trying to sell 70 trillion, so they can't put it in chuck it in one day. And of course, half of those trades will be wash trades. But they buy at 10 o'clock in the morning and sell at 10:01 in the afternoon, 10:01 in the morning. So probably the market can only absorb a few billion a day. So it's going to take them a long time to sell. But what if all the other banks say, my God, if they're doing it, they're going to get ahead of the curve. We want to be ahead of them because we're going to see lower prices. So it could turn into a little bit of musical chairs. Who gets to sell their bonds first? I don't think Norinchukin Bank are alone in saying this doesn't work for us anymore.
And I mean, maybe this is the reason why the yen keeps dropping, because maybe it's telling us that the whole Japanese financial system is in trouble because of this. We'll have to see. And I think if you look here, the 160 level is like a 35-year high. So if it breaks through that, we could see this chart here, Clive, that you've probably looked at, the price of gold and yen go even further up. I mean, I can't go back further than '07, but we were around 64,000 yen per ounce. Now we're at 375 almost. So yeah, what about Clive? What about non-Japanese banks? They could be in the same trouble. Banks in the Eurozone or banks in the UK. Um,
Yes, well, the minute the US yield curve is negative, which it is the case now, that means short-term rates are higher than long-term rates. That's going to be a problem for all kinds of hedging, unless your domestic rates are quite high as well. I haven't gone into the maths, but I've been told that the carry trade, as it's known, works quite well for people dealing in Turkish lira, but I haven't looked into that, so don't quote me on that. But of course, they have quite high domestic rates. But if you have very, very low domestic rates, it probably doesn't work. So I can imagine that there's other organizations, companies, and central banks and banks around the world who are in the same sort of situation where the carry trade is not working as well as it used to, and certainly it can't work as well as it used to if you have a negative yield curve, because at that moment you're paying a lot more for your hedging than you're getting on your earning on the bonds you bought. So I think there could be a lot of people looking to unwind this trade over time. And not least of which would be the investment funds, the bond funds, which are owned by pension funds around the world. So historically, many pension funds all around the world would buy a hedged dollar bond fund. Why would they do that? Well, because the choice of bonds in dollars is huge. There's an immense choice of dollars, and therefore, if you have a bond fund, the volume is there. You can own, and it's liquid, so you can own a lot more dollar bonds and have a lot more choice, and therefore try and pick and choose the best interest rates in your fund than if you have a domestic fund in, let's say, pounds or euros or some other exotic currency like Swiss francs. I mean, I don't mean they're exotic, but you know what I mean, they don't have the volume. So people would set up these funds around the world in dollars and then hedge the currency risk back to the domestic currency, pounds, euros, Swiss francs, whatever it would be. And that worked fine because it gave you the dollar yield minus the cost of carry, which is the hedging cost. And that was all great until the hedging cost exceeds what you're earning on the bond portfolio. And that's where we are today, with short-term rates higher than long-term rates. And don't forget, the cost of hedging is the short-term rate in America minus the short-term rate in the country where you are. That's the
Turkey here, the short-term rate is 44.6%. But
yeah, so it
work?
probably works there, but I'm not sure I want to
Yeah.
get involved with Turkish lira. I don't know anything about it.
But I guess the next FOMC meeting is July 31st. That's the last day they will announce whether they will do anything. And how long, is it possible that, yeah, I think this could break, couldn't it? Just like they kept rates at zero or negative for so long and did so much QE. Do you think there's a danger of things breaking, not just in Japan, but throughout the world, as the Fed keeps rates where they are?
I think if a panic sets in a Western country, and that would include Japan, it would include the UK, it would include Europe, and of course the USA. If it sets in any Western country, people will start to say, we could be next. So it could turn into a sort of crisis where everybody's running for the door at the same time and trying to get rid of their bonds and get rid of their cash and turn it into other things. And the obvious place to go, I think, in the short run, is gold, because it seems to be a very secure asset to many. Most people don't have any. They've probably got far too much in equities. And there's another thing to say. The top shares in America are going higher and higher and higher on a daily basis, but the volume of those top shares, volume traded, is dropping. Now, obviously, that does stand to reason to some extent, because of the price of the shares are higher. You'd think that people can afford less shares, therefore the volume does go down. But I think the other thing which is happening is we've got the last remaining buyers, and they're not going in and buying directly these leading shares. What they're doing is buying the investment funds which have the best performance, because it hurts a lot if you go and say, I'm going to go and buy a Nvidia or a Microsoft when it's an all-time record. You feel like a fool. But if you go to a fund which has got an extremely good track record, you don't feel like a fool at all. You feel like a wise man.
Yeah.
But that fund with an extremely good track record will own these top shares. So I think with the volume getting thinner, people are still pushing money in, but less and less into these funds. And it's getting into quite dangerous territory because at some point somebody's going to say, probably he's not even watching the market. You know what? I think I'd like to buy an apartment in New York, and he's going to sell his ETF or his fund, and then they have no choice but to sell the underlying, which will be, of course, the biggest shares in America. So there's lots of room for something to break. It could be the currency, it could be on the interest rate front on the bond side, or it could be in the stock market. And I think if something does start to break, people are going to run to gold at that point.
And Nvidia, they did a stock split 10-1. So their share price now is 130, I think, but it would have been $1,300 before the split. So it's people are probably still buying it. And I saw that back in the late 90s, Apple had loads of splits before we had the top in 2000. But maybe you could talk about gold because a lot of people um, that are not in gold or don't follow gold so much and listen to the reasoning that because interest rates are higher, gold should go lower, especially what they call real interest rates. But it doesn't seem to be happening. So maybe you could go through that. You talked about that.
Yeah.
You wrote about that.
So back in December 2015, the interest rate, the US Fed funds rate was 0 to 0.25%. And that's on the 16th of December, they raised the rates for the first time in many, many years. The gold price on December 16th, 2015 was $1,072. We've now seen 7.5 years of interest rate rises. We had a rise and a dip, but we had the rise after that again. So we had 7.5 years when interest rates have been on the up. They've gone from 0.25% or 0%, if you like, to 5.25 to 5.5. At the same time, over those 7.5 years, the gold price has risen from $1,072 to, if we take the point where the last rise happened, the last rise was in July 2023, 26th of July. The gold price on that date was 1,970. So that period of rising interest rates, the gold price rose 83.5%. That's over 7.5 years. So it rose a good 10% a year, despite the rise in interest rates. So I guess the first point to make is it doesn't care what the interest rate is. It cares about other things. Interest rates can seem to be a factor in influencing the gold price in the short run, but in the long run, gold doesn't care. That would be my first point. And the second point I think I can make is that it doesn't take any notice of the official inflation numbers. It just doesn't believe them. And to illustrate that, we've seen that the CPI inflation, which peaked at 6.5% in March 2022, that's come down to 3.4% now in just under 2 years, about 2 years. Yet the gold price has gone in that period from 1,936 to 2,324 yesterday. So I think it's 2,350 or 60 today. It's up. The gold price is up 20-odd% at a time when the inflation rate is literally halved. So again, it doesn't seem to care that inflation is falling according to the official numbers. The reality is that those in the know don't believe those numbers and are saying, I'll have some gold, thank you very much. And it's also behaving inversely recently to the dollar index, because the dollar index has recently, we've seen a rise in the dollar from about 99 to 105, and the gold price has been rising in that period as well.
Yeah.
And I think the last thing the gold price doesn't care about is what China's doing. I mean, it does, but actually we saw that in China there were not actually any purchases of gold, or rather the central bank's gold holdings did not change during the month of May. And just to clarify that, there was no announcement that I've seen by China. I've looked for it very much. There's no announcement by China saying that's what they're doing. It's just you could determine by looking at the numbers that the gold holdings in the month of May, for the first time in 18 months, did not increase. But yet in May, towards the end of May, the gold price hit an all-time record. So the all-time record in the middle of May was something like 2,421. So China wasn't buying, yet someone was buying. And I think it's the people who are in the know. They're saying, I like the look of this. I don't like the way the government debt is going. I don't like the real inflation rate. And I don't like the fact they're going to lower interest rates down the line. That's what people think, which means that the real interest rate will drop.
Yeah, and the other thing, Clive, is when they're watching what's going on in the banking sector, not just with Norinchukin, but also what happened last year, and the fact that these, I'll show the viewers here. Where is it? Yeah, the fact that we still have all these unrealized gains or losses in U.S. banks, and also the fact that we talked about this hedging situation for not just for Japanese institutions, but maybe Eurozone and UK institutions. Maybe that's why people are saying, well, we need to take some of our money out of these banks because we've got over 250,000. And what can we buy that is outside the system and that has no counterparty risk? Well, that's physical gold. And I would add that a lot of people still believe that when they buy gold through the bullion banks, that they own the gold, even though it says it's allocated and it's there on their account. I bet you they'll make it really hard if you want physical delivery. So I would say gold has even more room on the upside. And Clive, well, to do the dollar index, back in March 2008, gold reached over $1,000 for the first time ever, as you can see here. I think the high was 1,032. Yeah, and I remember that day really well. That was the day that Bear Stearns had to be bailed out by J.P. Morgan with the help of the Fed. And guess where the dollar index hit on that day? It was at 70.69, which is the all-time low in the dollar index. And so the dollar index has gone from around 70 to 105 now, and gold has gone from 1,000 to 2,400. So what I'm trying to say here, I think people focus too much on the dollar index. Maybe in the short term, it has some impact.
Yeah, but I mean, we must remember that the dollar index is it's comparing a declining currency, the dollar, with currencies which are declining at the moment faster. So we're looking at the best of a bad bunch.
Yeah, and I'll just show you, if you don't believe me, what I said about the dollar index here. Because I've got a chart here of it. And we can see, hold on. There you go. So you can see in 2000, is this thing gone off here? You can see in 2008, yeah, we hit, I still remember 70.69. I remember that number. And that's when gold was above 1,000. And we've gone up this way, dollar index, and gold is above almost 2,500. I guess I've been telling the viewers for years that fiat currencies, including the dollar and all of them, they're all going to sink versus gold.
I think the question is whether gold will be one of the better or the best, maybe, performing asset going forwards. And I think there's a lot of chances, especially when you have a stall in the stock market, that gold will take the lead. Incidentally, I did get a paper through from a bank which is extremely well known to me. I won't say the name. Yesterday, which for the first time ever, they've said increase your gold holdings. Well, I suppose they've said it before, but I've been watching them for many, many years, and their goal was either 0 or 3%, and now they're talking about. I didn't see the percentage, but they're talking about increasing the weighting to gold to protect against volatility. Now, you need to know what the word volatility means when a bank tells you volatility. It means going down. Of course, the real world of volatility means it could go up or it could go down, but banks don't like to say things are going down. So they say to protect yourself against volatility, increase your holdings of gold.
I guess, do they mean stock market and the bond market going down?
Yes, I mean they're talking. I think most of the banks are talking in terms of the stock market, but of course the bond market is risky. If we see a steepening of the yield curve and the long end of the let's say the bond we have, which is the 10-year, it's 4.25 at the moment. Let's say it goes to 5%. That would be a substantial capital loss in the price of the bond. So it is a risk as well. I think if I just touch on another risk for the bond market in general, there will be countless private investors who own bond funds which are invested in US dollar bonds, and they will have had them for a decade, and those bond funds are all underwater. And when they were sold them, they had a nice promise, the blah, blah, blah promise about how much you're going to make. But even with the interest added, they're probably all underwater, less than what they paid for them. And I think people are getting very tired of these bond funds, are starting to say to the managers, why I'm in bond funds where they're not giving me anything? Shouldn't I be in something else? Well, of course, the direction of travel is and has been put it in equities. But when equities stall, where are people going to go? And that's where I think I think it's one of the arguments for gold. And by the way, this isn't investment advice for anyone. It's just what I think. But I think gold's got a number of other things going for it. Obviously, it doesn't seem to care about rising interest rates or falling interest rates, maybe. But obviously, the betting is that we will have a cut in interest rates at the moment. Probably they say, or the market's saying maybe September and definitely next year. Well, I'm not sure I believe that, but that's what the market says. I think that China, which did not buy any gold in May, will definitely resume buying. It's got far less gold than Germany, Italy, Switzerland. So really, it needs to play catch up with America, but with Europe, it hasn't even caught up with America. So it hasn't caught up with Europe. It's got a long way to go before it catches up with America. So I think Chinese buying does resume. It perhaps already has done. As for inflation, my assumption is that it will rise. There's a slightly different view from the Fed, who thinks they're going to get down to 2% next year. I think that because of rising inflation and possibly a cut in interest rates, we'll see the real yields fall. That, of course, is good for gold because it means that the yield you're getting after deducting inflation is much less, and therefore the cost of carry of gold is less. And of course, if you deduct your taxes, it's even better. That's even a stronger argument to hold the gold, where you don't have any taxes unless you have capital gains tax. And Mario, you've mentioned that certain coins in the UK don't have capital gains tax on them, coins of the realm. And I think the last point is what's going to happen to the value of the dollar if the Fed does start cutting rates in September. It's been propped up by the assumption that the rates are going to stay high for a long time, higher for longer. But the minute they make their first move, people are going to start factoring in some future moves. And I think that will cause the dollar to fall. And if the consequence of that is interest rates at the long end rising, which I think is a likelihood, we then have the Fed, which will almost certainly step in and do what's called quantitative easing or yield curve control. In other words, they will become the buyer of last resort of government bonds because the government doesn't want to sell them at 5.5% interest rates because that's going to just totally destroy everything very quickly. They'd like to sell them at today's rate of a 4.25%. Now, maybe 4.5 is acceptable, maybe nearly 5 is acceptable, but there'll come a point where the government is saying we should not sell bonds at this rate because it's just going to destroy everything. So the Fed will be quietly persuaded, I think, to step in and start buying those bonds. But what does it buy bonds with? The only way the Fed can buy bonds is with printing new money. So it will print money. And of course, whilst the production of bonds is inflationary because it's promised by the Treasury to supply cash later on, turning it into cash immediately because the Fed's buying it with newly printed money speeds up the whole process of inflation much, much faster. So I think that's coming down the line. I'm not sure about the timing of it. Maybe sometime next year, I would say. But, things could get out of hand quickly. We don't know when. It might come quickly. So I think there's a lot of things going in favor of gold. And whilst it's not investment advice, those are the reasons I think I would still be buying, and I still am buying, by the way, at today's prices.
I agree. And the other thing that's interesting, you were speaking about bond funds, because let's say you invested in a 10-year treasury or a Bund, German government bond, 10 years ago, and it's maturing now. And even though the price maybe a year or two ago dropped quite a bit, you're going to get your full 100 euros or $100, let's say. Um, but when you invest in a bond fund, the bond fund never matures. So you get hurt a lot on the capital. Is that something that people are not seeing as well? Because yeah, it seems like, you could hold, let's say, a 10-year bond that was issued 5 years ago and is now trading at 80, right? You hold it for another 5 years and you get the 100% of your principal. But if you bought like a bond fund 5 years ago, um, there's never going to be a maturity and you're never going to be made whole. Is that the problem with bond funds, you think?
Well, this is certainly the psychology of the investor. Uh, the more sophisticated investors would perhaps have said, I will buy myself a 3-year, 5-year treasury, and even if interest rates change, I lose money, I'll still get back 100 at maturity. I can wait it out, and I'll just have to accept that I could have had a better price. But if you buy a bond fund, that psychology can't exist, because as things mature, they're reinvesting them constantly. They have a whole range of maturities. So a bond fund will have what's called a duration, which is similar to maturity, and it's always shorter because of the interest rate payments coming in. Uh, and the longer the duration is, that duration in general never gets any shorter, because they're constantly taking the maturing bonds and refreshing them into the longest dating bonds, keeping the duration usually typically where it is. So you really have no maturity date, and therefore you're constantly subjected to a declining bond market. You don't have that reassurance that one day I'm going to get my money back, and I'll be back where I started psychologically, even if I could have done better. And that from a bond investor's point of view is a frustrating thing, because you don't know what the bond fund owns. I mean, you can know, but I think most investors are not that sophisticated to go and study it and say, oh, that looks all right to me. They just say, I bought this 10 years ago and it's down on my purchase price
Yeah,
and I don't want it.
Clive, just a little bit more on gold here, because before we came on, you were telling me how gold is, well, the close last month in May for gold was 2,327. And now we're at 2,357. So we still have about, well, 10, 8, just under 10 days to the end of the month. So it looks like we could make another monthly closing high for gold,
Yeah.
which is very bullish. Of course, this chart here looks very bullish.
If the gold price stays where it is today, it will be the highest ever monthly close. And I think that says a lot at a time when inflation is supposedly coming down, interest rates are about to come down. China, so according to the news stories, didn't buy any gold in May. And obviously some people said it was an announcement, which it wasn't. Therefore, they're thinking maybe they won't buy in June. I think it's significant that gold is making highs despite all the signs, if you take the traditional signs that are supposed to be bad for gold, going in the wrong direction for gold. The buying's out there. So imagine what happens when the signs turn in favor of gold. The buying will become much more aggressive.
And here's the quarterly chart as well. Last quarter, the high was 2232.75, and this quarter's low has been 2231. So there's no gap, and it looks pretty bullish as well. And let's have a quick look at silver, Clive, because silver, uh, a lot of people, and understandably, think that the 30 level is really key, but
It took a very surprising big leap yesterday. I don't know if you saw that, Well, you
yeah,
probably did.
yeah, I did. But
3 or 4% up, I think.
but silver as well, like if you look at it on a quarterly basis here, the last time we closed, Yeah, back in the first quarter of 2013, so 11 years ago, that was the highest closing up until now, and that was at 28.28, and we are now just above 30. So, yeah, if we can close above 28.28, I think it's really bullish, even though it's below 30. And yeah, it's quite volatile. And I've noticed today, Clive, that as you can see here on my screen, that silver's down 1%, but and it could go back below 30, but then tomorrow or maybe next week it will go back above 30. And gold's holding quite steady. So any final thoughts, Clive, for the
Well, I think there's something which went under the radar screen last week, and that was a letter written by Senator Elizabeth Warren and two other senators to Jerome Powell, in which, if I paraphrase a little bit, they more or less ordered Powell to lower interest rates. Now, the Federal Reserve is supposed to be an independent central bank. And I could go into a lot of detail in the letter because it's like 5 pages. But if I just read perhaps the first paragraph, you'll get the gist of it. Dear Chair Powell, we write today to urge the Federal Reserve to cut the federal funds rate from its current 2-decade high of 5.5%. Then they go on. Amongst the arguments they give for cutting the interest rate are things like if you remove things from the inflation index, which have gone up in price, you'd be within your target. For example, they suggest in this letter removing shelter, and they say because shelter's rising a lot because you've got a lot of people coming into America, the supply of housing has dropped a lot, and so you've got more people and less supply, and so the cost of rent has gone up. So they suggest removing shelter because that's not a true reflection of inflation, and that would bring him down to 1.8% inflation, which is his target, which justify him for removing the or reducing the interest rates. Another thing they think which could be taken out of the index is motor insurance, which is up 23% in the year to April, and they suggest that that's not a true measure of inflation because it's caused by people having more car accidents rather than rather than interest rates. And there is actually a very weird sentence which anyone who's a student of logic will say this is ridiculous. But I'll read it to you.
yeah.
Uh, Overall, inflation would have been only half a percentage point away from the Fed's desired 2% if auto insurance was excluded. Now, here's the sentence which doesn't make sense. But the increase in the cost of motor vehicle insurance reflects factors including a shortage of mechanics, more accidents, climate change, leading to more vehicles damaged. None of the here's the none of these factors are mitigated by high interest rates. In fact, the Fed's rapid interest, so none are mitigated by interest rates. In fact, the Fed's rapid increase in interest rates in 2022 may have had the opposite of its desired effect, prompting insurers to raise premiums. So there you go. Because the Federal Reserve put up interest rates, car insurers put up premiums.
Well, it's ironic though as well because in a world that's so financialized where everyone does a lot of stuff on credit, if you do increase interest rates, you're going to get higher costs. So that's kind of maybe they have a slight point there. And talking about Senator Warren, I saw that writing to the Fed urging them to cut rates. We saw yesterday as well, Clive, an MP here in the UK, Jacob Rees-Mogg, he complained because the Bank of England did not do anything yesterday, and they hit their target of 2% CPI. And he thinks it's political because we have an election on the 4th of July. So yeah, it's not just the UK. So it says here that in the Express, Jacob Rees-Mogg erupts at Bank of England over interest rates. So there you go. Anyway, Clive, hopefully the weather will improve in Switzerland. Here in oldie England, it looks like we've got summer again. Or well, it was supposed technically it started yesterday, and it's really nice. So yeah, I wish you a great weekend.
Thank you, Mario, and all your listeners. Thumbs up and subscribe, huh?
Yeah, and also if you want to get in touch with Clive, you can try to connect with him on LinkedIn, Clive Thompson.
Yep, I usually accept everybody's connection requests, and a lot of people write to me with financial questions or problems. But if you write to me saying, "Hello, Clive, sir, how are you keeping?" you probably won't get a reply.
Yeah, okay. All right. Take care, Clive, and thanks again.
All right, bye bye now.
Bye.